we're just going to go ahead and get started. Thank you for joining. Obviously, this video will be recorded and sent out if you couldn't make it. So welcome to Real Estate Accredited. This Thursday, October 5th, 7 p.m. Eastern Standard Time. Today, we're going to go over some real estate education and then possibly some networking. Philip, go ahead and take it away.
All right, yeah, like Jeff said, thank you for joining us every Thursday, 7 p.m. Eastern. Hopefully, all right, we have some people coming in. Keep an eye on the participants, please.
Sure.
Today, topic of the day, it's the active investor point of view and worst case scenarios. Last week, we spoke about the passive investor point of view and worst case scenarios. Our focus is in-place commercial multifamily value add. So basically, we're buying properties that have been built in prior to our acquisition, and our typical, that's the in-place part, and our typical strategy would be to do value add by, for instance, doing renovations of the units. So what is the active investor in the deal? And here I put also like the deal sponsors explained. Maybe we can start by that. The active investors, they are also being called the sponsors of the deal and also the general partners in a deal, in a syndication. And what's their I put definition, it's really what's their main role is to obviously put together large real estate projects. Then they're going to oversee day-to-day operations of that particular project. And finally, they have a fiduciary responsibility to investors, meaning that they have the responsibility to do what's best for the investors. As usual, I didn't mention, if you have any question, we're a small group, feel free to unmute yourself, ask a question, or just post it in the chat. I see we have a Michael without a microphone there, so I don't know if he's connected.
Yeah, he's trying to connect.
Okay, so if there's no question yet, I will move to the next slide. So, what's the active investor's point of view? What's their approach? What they try to gain and achieve by doing the syndications? I think number one is they certainly have to have the spirit of entrepreneurship, because now you're going to run a business. And also their goal is going to be to scale their business, do more acquisitions and more properties, but also leverage investors' capital. And I think it goes also back to the scaling to be able to buy larger properties. They're going to basically make their money through sweat equity, right? Because they're going to put the work, put the effort, and they're going to get a piece of equity that's the result of their work. Finally, here, I think that's something maybe not necessarily known, but by being active, they're going to have the real estate professional tax status, meaning that any passive loss on a deal where they would be passive and not active, it would be counted against active income. There are some scenarios where it's very interesting to have that tax status. You can write off a lot of your income that way.
Philip, how do you call yourself a real estate professional? Is there some paperwork to do, or how does that work?
So it's a tax filing. Actually, my CPA mentioned that to me this year. She was looking at triggering or not the real estate professional tax status. So it's an election in your tax forms, but there are some requirements. So here, what I'm saying is basically by being active, you're going to fulfill the requirements. And I think the requirements, you must basically spend most of your active time on real estate, and it has to be more than 750 hours, I believe, or something like that.
Yeah.
And I think that's about it.
Yeah,
Is that right?
the 50% of your services in the real estate trade, more than 50% of your services. That's a very vague statement, but as long as it's 50% of your services in the real estate trade and perform more than 750 hours in the trade, that's the real estate professional test.
Yeah.
So when you break it down to, like, most people have a 40-hour work week,
Mm-hmm.
and then you add 150 hours, that's pretty much almost like two full-time jobs in a sense. So just something to consider.
Yeah.
But
And
yeah, how much does that work out to per week if it is 750 hours divided by, say, 52 weeks? It's about 14 hours a week.
yeah, but it has to be more than 50% of your professional occupation. So technically, if you're spending 40 hours somewhere else,
Uh-huh.
you would need to spend 41 hours in real estate to qualify. It's both. It's the lesser or the greater of, in terms of hours, 50% of your professional activity, or at minimum 750 hours.
Mm-hmm.
Yeah.
Okay.
Yeah, maybe that's the better. That's why here, and really, I think what I want to convey, and I think you can certainly, our focus, I think, is a lot on syndications. If you're running a few buildings by yourself, it's a kind of a different situation. But really, and I think that's something actually I thought about when I prepared that slide. When you start doing syndications and buying like larger projects, it becomes very quickly a full-time job. And for deals to be successful, you're going to have to do that full time. And I would say, as a passive investor, it's one thing if I'm going to invest with a friend who's starting in that business and so on. But otherwise, I would look for people who are doing this full time and not part time necessarily.
Yeah.
Now it's at least one of the team members doing that full time.
Yeah.
So what was the experience of as an active investor? What are they going to do? I remember a few weeks ago we spoke about the timeline overall, but basically those are the same things we have here. Number one, you're going to focus on deal flow, making sure that you have enough deals coming to you that you can analyze. Then proceed, and I'm more actually focused on the experience when it comes to the deal itself. But I think at the end of the day, there's certainly a need to maintain investor relations. That's something also to take into account. So number two, underwriting of deals to make sure qualifying the deals if they make sense or not to pursue, and making offers, etc. Once you offer, or around the time that the offer is accepted, and when you start writing the contract, there will be a negotiations phase, followed by due diligence. In other words, again, making sure that everything that your estimates, your assessments and estimates, etc., everything is in line with what you observe in reality when you do the inspection, for instance, and you analyze the financials. Also, you're going to talk to a lender about financing, do the capital raise, and close on the deal, which is, at that point, it's certainly, it's a stressful event, but it's typically more like a formality. But see that, so there's a lot of activities prior After you go to an asset management mode and really like implementation of the business plan, working with a property manager, for instance, or construction crews, etc. And finally, you're going to have the disposition, selling the asset, which also, I would say, regularly through asset management, you're going to talk to brokers and see what's the value of the asset. Okay. Oh, sorry. Going the wrong direction. I guess today is going to be exceptionally short.
When you build a team or being an active investor, do you look for a team where one person focuses on deal acquisition and one on asset management, or is it like everyone is an expert at different things, or everyone handles it together?
I think it's a case by case. When I work with students, particularly on the deal flow, especially these days, it's little deals are not flooding the market by any means. Because of the high interest rate, prices that can be achieved are not really ideal for sellers. So what I recommend students to do in that case is just to have people team together and each of them focus on a given market. That's from a deal flow. Usually, naturally, there will be always somebody who is more into underwriting, but I just spoke to a student earlier today, and on their team, they want everybody to be capable of underwriting, because what the student was saying, and he's right, he doesn't want just everybody to throw anything that they receive without doing any filtering.
Yeah, that's true.
It's counterproductive for the underwriter.
Yeah.
Right? So you need some kind of filtering. I think what's important, though, is probably because there will be different conditions, there will be different parameters. But what's important is to agree on who is responsible for what. Roles and responsibilities.
Yeah.
And make sure that it's going to be balanced and it's going to be thorough, and there's an accountability part of it, because there are financially, there's some money that's going to be spent, money at risk. Actually, it's part of my next slide. It was like, what are the risks, right? Worst case scenarios. That's something that passive investors don't experience, but it's not unusual that money at risk, such as an earnest money deposit, is lost. It's very, I think I don't know a syndication group who didn't experience that, really. There's always something that can happen. More recently, it has been interest rates that were, getting higher very quickly. And you may have started your underwriting and with a set of conditions, and then when it's time to close, you have your proceeds that are reduced by 10-15%. So now the deal doesn't work anymore. So your options are, you try to retrade, meaning that you want to lower the purchase price, but the seller is going to say, no, you committed to buy at this level, I'm selling at this level. And at that point, you may have $50,000 or $100,000 in hard money, because the honest money at that point became hard because you're close to closing date.
Yeah.
And that's not counting now. You have EMD here, you have loan application that may be lost if you don't close, inspection cost, it adds up, travel cost, etc. So that's one thing. And what I recommend, I have a template for basically, if it's a team, if it's like you mentioned, Rajiv, it's like a team you put together.
Yeah.
And it's not necessarily people who have worked together before. It's good to put the roles and responsibilities on paper. What you can use is, I have a template for anyone who was interested, a template for a JV, so a joint venture agreement that is going to run during the acquisition time, and then it dissolves at closing.
At
Or it
disposition.
dissolves. It dissolves if the property doesn't close. So in either case, it dissolves.
Oh,
But
it dissolves at closing or disposition?
no, closing.
Okay.
Closing, because after closing, the operating agreement of the LLC would take over.
Oh, okay. So you do make a new LLC for each property,
Of course,
right? To the new...
yeah. You have to, because
Yeah.
Again, in the context of a syndication, you're going to have different members, potentially on the GP side, on the general partner or active investor side, and limited partner. The more established groups, again, they're going to have their team, however they work on the general partner side, is going to be more constant. There will be always different limited partners.
So I had a question in the previous slide, actually, one.
Okay.
These 8 areas, what do you find the most challenging? Is there a particular area that you find?
I think one that doesn't get enough light or spotlight,
Focus.
let's say, it's
Focus,
the asset management, because there are a lot of courses and programs and whatnot out there about everything else. And I think I wouldn't say it's easy. It's not rocket science. So if you do, after, it's a matter of, if you analyze enough deals and you're underwriting, you build the relationship with different third parties, etc. And even, let's say, negotiations and so on. Let's say you work with a mentor, for instance, to have some guidelines. You have a lawyer on your team from a legal standpoint. All these things, it's relatively, you can go through them, and it's going to be stressful, but after, it's going to last, the actual acquisition, like 3 months, and after you'll be done. But the real success, or I don't know what's the opposite word of success or failure, is going to be through asset management.
And also, it is if you look at a time standpoint, it's the biggest chunk of time, all the other part, right?
Yeah. Yes. And that's something, and it's not the most sexy, appealing part of it, but that's the most critical. It's the most critical, because if that's done poorly, there are so many,
the whole deal breaks then.
Yeah, the whole deal breaks. And I have, and that's again now, and again, I think that's what I have in mind is really covered here, because we spoke about loss of risk capital, right? So pre-closing. But the challenges, I think the challenges are already here. It's 2, 3, 4, 5. On occasions, you'll have is sponsor disagreement, let's say, the team, if it's a kind of a, but that's not, I think it's a risk. Right? I think at the end of the day, if somebody's not happy, that he's just going to be less active and he let the other guys take care of it. But the risk is you may have operational issues, and it could range from, is it a market? Is it like suddenly population growth is not there anymore and rents are turning around? You have to give super high concessions to attract tenants, or suddenly there are a lot of evictions in the pipeline, and all of these things I'm talking by experience. Those are operational issues, and you may have the best asset management team in place,
but if the market is changing, then there's little control.
You cannot do, at some point you're going to do the best you can. And now sometimes it's very difficult, or it's not, I shouldn't say that, it becomes a little challenging to make the difference. Is it a market problem, or is it for instance a property manager problem? So that's where it helps as an active investor. You want to have multiple assets in the market, and ideally you're going to, granted your portfolio is large enough, maybe you're going to work with more than one property manager, just to have a little bit of variety. And here
then you get an idea of who is doing better or not, right? If
Yeah, and
you're
just to
going
see, okay, because it's like I'm managing an asset now in Memphis, Tennessee, and I have to take the right now. I'm taking the word for the regional manager was telling me
Yeah.
like the whole market is impacted. But quite frankly, what I should do as well is probably like talk to other owner and
to
just to
understand
make
if it's
sure,
the
you know,
market. Sure.
is that a thing that we're seeing throughout. Now, at the meantime, we just experienced for several months, like our list of evictions is growing.
Japan,
And it came out of nowhere, pretty much.
So that
You know.
certainly increases vacancies and the cost to legally remove people, right?
That's right. Yeah. And right now, that particular property, we are at 80% occupancy,
Okay.
82%, which is not great. And we just decided to reduce to give 1 month's concession basically on the
Okay.
rent.
Okay.
Like
So that's an additional cost that has to be borne.
yeah, it's a loss. It's a loss to lease.
So throughout
Most
this
of the
process,
time.
do you inform the passive investors of what's happening
Of course, yeah.
frequently, or
I mean, it depends. You know, maybe at the beginning you're going to do monthly,
Mhm.
let's say, and after you switch to quarterly
Mhm.
after a year or two, let's say, and yeah, but you have to tell them what's going on.
Some owners like it weekly as well. Like one of my clients, we do weekly meetings. I was telling you last week, Philip, with the asset management piece.
So do you do meetings, or do you generate reports and give it out to all the investors?
Well, it depends. From on my angle with my clients, some clients like a weekly report, some like
Mhm.
quarterly, some like by every 6 months.
Mhm.
But this particular client, it's a 60 unit portfolio, and I'm a new asset manager to him on a weekly. It's okay. I'm giving you this business. I haven't really heard about you before, briefly, so I'm going to give you a shot. And it's only like a piece of the portfolio. Now I've earned the rest of the business of adding another 200 doors to it. So it's giving it to me piece by piece. One of the things you're saying, Philip, the eviction process, it definitely gets to those numbers. I'm going through 1, 2, 3, 4, 5 evictions right now.
Oh, wow.
6 evictions, and it's at about $8,000 so far I've had to spend with legal fees.
What market is this?
I'm in Boston.
Boston.
Yeah,
Okay.
Boston.
Yeah, the unfortunate part is that you're probably never going to see that money.
Never.
Yeah.
And in some states, if they pass judgment, the judgment can last about 12 years, which is good, depending on the state. But you have to get to that portion first to get the judgment, and they agree. Okay, yes, we do owe him rent, but good luck collecting that. Then you have to go through putting liens on their property or whatever they owe, and half the time they don't owe anything.
Exactly.
Or garnishment of wages, and that's an entire process. There's processes out there, but it just becomes a time-consuming.
Doesn't make sense financially, right?
Especially if you have to have the lawyers do all of this and just accumulating fees, which you can add it to what they owe, but they're never going to pay it. So it's
right now, our attorney, keep bringing them. We're friends. Please, it's pretty costly. And again, out of a portfolio of 60, the 60 units, that's 6 vacancies or 6 units that's not generating any revenue. And then you still got to spend that maintenance cost of it's costing me $6,000 per unit to run the unit per year. So imagine that 6,000, that loss, plus the timing that they're in the unit going through the eviction process. So one unit, about 70 grand on one unit. Literally, that's 70 grand. We're never going to see that back again. And that's on each unit. Because you're losing that revenue of, I think, what is it, 1875 is what the rent is for the 2-bedroom.
That's why it makes sense to look at tenant landlord friendly states.
Yeah.
And counties.
Massachusetts is definitely not.
Yeah, that's anyway. If you're unless you're local to those markets and you understand very well And I would say that the thing is you have to take that into account in your underwriting.
So is there ever a case where you have these tenant squatters who don't pay rent and you're not able to evict them?
To be honest, so let me tell you one quick scenario. One of my tenants passed away. He's a voucher holder. It's a 1-bedroom, and his ex-wife, I guess they were still married, but they were separated. She has taken over the unit, and she has been in there since June. So we are at, what's that? June, July, August,
September, October, 5 months, yeah.
5 months. And we're just now getting an order for her to go to court, to show up to court to take back possession of the unit. But in that 5 months, that unit was being rented at $14.92? It was $14.92. So I'm losing $14.92 over the 5 months.
Oh, wow.
And plus the cost of what it's costing me to pay the legal fees.
Mm.
I'm not getting that back.
Not to mention turning it and the increase of rent that you're missing out on. Like
and
in California,
California,
because a property in California, and it's missing out on $3,500 a month every time that property is not being rented because a tenant is refusing to move. And then talk about tenant friendly and not friendly. California, they even have risks that will only help as being teach them how to bypass that and how to extend that, and it's just insane.
I guess that's the business we chose, right?
The location. This is when it actually
yeah.
has some meaning, right?
Absolutely. And the tricky thing about my situation, this is the affordable housing market. The fees that I can collect can't go past 5%. So that's even more of a struggle. So that's why, Philip, I was telling you, man, these light tech deals and having voucher holders in these units are the best thing.
Yeah. Milton joined the call last week. Yeah, it was nice to meet you. And you said you're going to move to Atlanta, right, Milton?
Correct.
So very interesting, like projects that Milton is working on, actually, with housing authorities and so on. It was quite interesting. Maybe like before we switch full gear to the networking part, let's just finish this slide, if you don't mind.
Of course.
We spoke about operational issues. I guess like the next, once you have operational issues, and I think we developed a little bit. We discussed some scenarios a minute ago. One of the issues, or one of the ways to stay afloat, is to have reserves. And if you don't have reserves, lack of liquidity, that's you're going to be in trouble quickly. If you're losing money, you want to have some reserves to be able to sustain some adverse situations for a bit, right? That's the minimum. And that's, again, that's something, the stress test, stressing your underwriting and doing, again, I give an example here, as how does the property performs when there's 70% occupancy. And that could be economical occupancy, meaning you may have some people in the units, but they are not paying rents. You may be at 60% occupancy, right? So what does that mean? Can you still pay your mortgage, the loan on the property? That's going to be a key indicator there. Again, what you want to do, I just mentioned, lack of liquidity is tied to having the reserves. And that's something, by doing the stress test, you're going to dimension your reserves accordingly. Worst case scenario, I think market volatility, in other words, being in adverse market conditions. I think I had maybe 2 weeks ago or 3 weeks ago, I had the cap rate chart, and basically was doing some kind of V shape. And being that the cap rate is inversely correlated to the price, meaning that low cap rate means high price, high cap rate, low price. Okay. And couple of years ago, we were in a low cap rate situation, high price. So if that's when you bought, these days were like this. market volatility has flipped the value of your property upside down. So hopefully, not a good time to sell. And hopefully you've taken the necessary steps to maintain or cap your interest rate, which is linked to my third comment here. Otherwise, if you don't have a cap, now you're really in trouble and maybe you'll have to sell soon for a loss. That's the worst case scenario here. 3 and 4 can really lead to selling at a loss, meaning that you're going to lose everybody's money or part of it. That's the worst case scenario here. And sponsor disagreement I mentioned already. I wish I ended this on a more positive note.
Philip, does that happen, or it depends on how conservative you're during the initial underwriting to prevent that from happening?
If you heard of properties that went in bankruptcy in Houston, it's a case study that with Jeff we took a close look at. And yeah, like all the investors' money was lost. There are rumors that the principal of the company actually has left the country. And they were a little bit reckless, right? They were a little bit reckless. And I think, they are very reckless, really. They are very reckless. But I think at the end of the day, the investors, they believed in the team and in what they saw. And in a nutshell, what happened is they purchased at the highest point of the market, pretty much. They didn't have reserves, but at least we don't believe they didn't have, or certainly they didn't have enough reserves. And then they didn't have rate caps. So when you add all these elements together, it became unsustainable. And I guess they could have maybe tried to find a happy medium, but they let the properties go to bankruptcy pretty much. And then so the lender took possession and they took a cut, I think, on the loans and gave the properties or sold the properties to somebody else.
So was it a problem of the team being inexperienced, or it was
that was part of it? That was part of it. Yeah.
Okay.
It was part of it. There was, and I think you know, when unfortunately I'm trying to find the slides if you're interested. Lesson learned. There you go. I have it right here. Let me try to open. Give me 1 sec. It's going to be fine. All right, let's do it like this. So let's see. Try to skip. So yeah, that's what 3,200 units. Right, that's back an article back in May.
That's a big deal.
And let's see, because what are our maps and so on? That's not okay. No, that's not the right presentation. So sorry about that. Which months was it?
It would be interesting to see the pro forma of that if that was available.
Yeah, we don't have it.
Yeah,
we don't have it for sure. June. Let's see. That's not the right one.
No.
Yeah, I was not prepared to discuss that. It was in June, right? That we spoke about. Still the same.
No, it was July.
It was in July.
After all that came out, which April, May, June. Came out in April.
No, but that's the Orion version. Maybe we can talk about it next time. So it's already
And plus it's on the YouTube channel as a webinar. We also talked about it on there.
That's right. Yeah, I can show you that. There you go. That's the video. Yeah, actually, so the real thing,
The real case study.
there was an additional huge property, like 1,100 units. So there's a total of 5 properties, 4,300 units purchased between August 2021 and April 2022. Those were like the different areas of Houston. And they defaulted on their mortgage payment. Basically, it wasn't a real foreclosure per se, but no, I guess it was. Yeah. But it was not public foreclosure. It's like the lender took over and
Right. There was like rumors of the GPs taking over the deal and working out of some kind of deal with Arbor, because Arbor held that note, the loan. It was Arbor, wasn't it?
it was Arbor, yeah.
Yeah.
It wasn't maybe the remaining GPs, not the lead guy.
No, the co-GPs.
Let's see what's interesting. Capital yeah, that's the interesting part, I feel. See the growth of their portfolio, right? So they went from 0 in 16 basically to 18 and started a little bit 1,000 unit at the end of 19. Relatively kind of constant slope here up to this point in 2021, and then just exploded. And one of the issues you are looking, I took a look at their website. They had 5 employees that they spoke about. It's like how do you take care of 8,000 units?
5 employees.
With five employees. Even if you have professional property management, you still need to spend, like Milton mentioned earlier, you need to spend time with the asset as an asset manager with the property manager.
Yeah.
Right. And I think they're like one of the things that we're ourselves looking for these days with JEP. We're looking at fully integrated sponsors who have significantly sized teams, but also in-house property management and construction as well. And the other thing is the reserves, which obviously it's a kind of in the middle of the presentation, but those are the two key points here. Takeaways in that particular misaligned partnerships. What did we say? What's the takeaway? Yeah, those are our criteria, which actually we upped since then. Well, we want more experience, more full cycle deals.
Well,
that's it.
All right. So, article, $66 million loan. I think we could start wrapping it up. If you care to plug in what you're working on, if you want to share anything, please do. If not, we thank you for joining us. Again, eventually we're going to send these out, like Phillips mentioned. We're going to post them on the Facebook, not the Facebook, I'm sorry, but the YouTube channel.
Yeah.
We have other videos of our actual webinars on there about various topics. If you're interested, you can listen to them 2x real quick. Some takeaways. We talk about a little bit of macroeconomics, just different real estate related topics. We delve into real specifics on some of those webinars. So if they provide some value, check it out. But if that's all, please feel free to chime in, talk about what you're working on, and maybe we can collaborate on something. If not, thank you for stopping by.
I got a question for you guys, actually, Jeff and Philip. I'm just trying to figure out I didn't get a chance to really read go do some research on you guys yet, but I'm trying to figure out what is it exactly that you guys do on your day to day. What is your company about?
Sure. We're shifting gears. So we've dealt with residential properties, commercial real estate. We're in several thousand doors. We are shifting the company's gear into we have a fund. Boost Capital has its fund, is the Boost. So the focus is to come with experienced operators into deals by providing the fund as a vehicle for investors to participate in. So our fund is unique because it's a customizable. So it's like you can build a portfolio within the fund, so investors can actually invest into the fund into multiple deals, therefore creating a portfolio versus going into multiple syndications from different operators. If we partner with operators, we could bring those deals into the fund. The investors are able to take a peek at all those deals, invest in the deals they want or like, and not worry about the ones they don't. And inside that, they create a portfolio. They get 1K1 from us. So we do all the heavy lifting in regards to the accounting aspect of it, our accounting team. And just it simplifies it streamlines the approach. So we do all the due diligence, the confirmation verification, just present the deal to the investors. Take that hard work out of that, as well as just bring an entire package to the investor. So we're focused on raising capital for deals and providing a streamlined approach for investors to just focus on receiving 1K1 during tax season.
Copy that. Okay, so you guys are going to be very helpful to me. All right.
We do scrutinize every deal, as
Right.
everybody should, but we also offer like assistance where we can. Growth is growth. Everybody's always growing, moving forward. Progress is progress. We help where we can, and we collaborate with folks that have mutual guidelines, and we could all benefit from deals, because deals are hard to come by, like true deals, not just those things that are thrown to the wall and see what sticks.
Absolutely.
So that's essentially, in a nutshell, top high level view of what we do. Philippe also does mentoring, as you're aware, educational stuff, so that too.
All right. All right. Thanks, guys. I'll see you guys next week.
All right, thanks, Milton. Good chatting with you.
All right. Have a good night, guys.
All right, good night.
You're mute, Philippe.
Yeah, there was another question from Jay Miller.
Oh,
If we're doing investor, the answer is yes.
yes, we are, Jay. So if you have any questions, feel free to shoot. We'll be transparent, but it could be at a later date. No worries. Michael, still there? I don't know if you got my direct message.
Yeah, I think this somehow Michael doesn't have the microphone symbol, so I don't know. He's not fully connected somehow.
Yeah.
Looks like it. Yeah.
Okay. All right. On that note, I'm going to go ahead and have you stop recording, and we'll end the call.
All right. Thank you, everyone.
Thank you.
Thank you for the appreciation, Jay.
Bye, Jay.
Bye.